The story today is the historic recovery in the market. It was a pretty big turnaround, but I'm not ready to let go of the part that happened in between, the part that happened when the bus was still rolling down the cliff. Well, the chaos grenade was officially released, and then, I guess the same guy threw himself on it. I'm not sure if that's how you put it. Didn't know grenades had take-backs. I'm making this up as we go. Now, I held off on this video because I didn't think it made sense to try to make sense of what was going on when nobody knew what was going on. But the one thing that we saw was how gold performed through the week, and I think that part's worth a video because it was maybe the one asset anyone would have been happy with. So we're going to look at that one thing, how gold did compared to the markets, compared to silver, and even compared to Bitcoin, because this is a great look at how gold does in a market crash, which is exactly what we just came out of. If you somehow missed it, or maybe you're watching this in the future, over this past week, we saw the highest volume trading session in the history of the US stock market. And that volume was selling. The S&P 500 was down 20% from the high February 19th, which is a technical crash, and that moved us squarely into bear market territory. And that kind of event is going to have an impact on gold. And we're going to dive into exactly what happened, but first let's get a quick shout out to Summit Metals. If you're looking for gold and silver, they have low prices, fast shipping, and great people. SummitMetals.com. Now, people are going to say, well, gold just hadn't had time to crash yet, and all the assets hadn't really had time to do what they were going to do, but I don't want to dance around it. I don't want to give you my own opinion after the fact. We can look at what Goldman Sachs was talking about right in the middle of the chaos. This is from April 7th, while the administration was still telling us there was no tariff reprieve coming. Goldman Sachs was out there saying, hey, this pullback in gold price is an opportunity to get in. And they gave gold their highest conviction view in commodities. Their words obviously doesn't really roll off the tongue, but they went on to reaffirm the bullish price forecast for gold in 2025. Again, this was happening while the market was crashing. This kind of thing's easy to say after the fact. They were doing it while we were in it. They pointed out that gold was selling to cover position liquidations, but they expected it to firm back up, and they stuck with that $3,300 forecast for the year. I'm just going to point out one other thing because they also mentioned it. Gold and silver bullion were exempted from any new tariffs. There seems to be some confusion there. I don't know where that's coming from. Somebody must be out there saying the opposite. We all know that fear sells. So a 20% drop in the S&P 500, I've mentioned that. What happened with gold? Well, gold dropped 2.5%. At its worst, gold had fallen close to 5% if we were going from its all-time high, which would be fair because that's how we're calculating the 20% drop in the S&P 500. But look, it had already bounced back to within 2.5% prior to the announcement that the tariffs were being rolled back, postponed, or whatever we're saying here. Now, that was at a time when analysts were saying the market could drop a lot more, and here was gold down 2.5%. That story is going to get lost in all the sexy stories about this historic recovery that came after the fact. It's going to seem like a blip looking back now that everything is heading back up, gold included. But it's important to understand how gold performs as a defensive asset to balance portfolio. Now, let's keep this going. Silver fell 18%, and that's not too far off from the S&P 500 performance. Silver had two factors working against it. First of all, it has a market cap that's only at 1/10 the size of gold, so it's going to be more volatile. And it also has a heavy reliance on industrial demand. Something like 60% of its supply goes to manufacturing use. So silver makes an interesting trade, but not going into a global recession, or at least the fear of one. I mentioned that I was interested in silver at $29, and I did pick up a little bit, but probably not enough to get too excited about. Now, if I had bought silver a few days before during the so-called silver squeeze, well, that would have been a different story. This is why you don't jump in on these kind of organized buys the day before a big announcement. Now, how about Bitcoin? Because that comes up a lot here. Well, Bitcoin fell 31% to $74,000, down from $107,000 when Robert Kiyosaki told us he was selling everything to buy Bitcoin, calling the rest of us stupid for not doing the same. Well, so much for Bitcoin being a store of wealth through digital gold. Kiyosaki here, I mean, he's just a sideshow. I just mentioned him because his timing was perfect. Perfectly wrong. Well, back to the markets, the NASDAQ was also down 20%. I think it was the first to hit the bear market. The Dow was down around 14%. This chart won't show each asset's local high, so the numbers here are a little bit off. So quick reminder, Bitcoin was down 31%, silver was down 18%, gold was down 2.5%. Now, none of this is to say what gold is going to do the rest of the year. That's not the point of this video, even though I think the range that Goldman Sachs gave starting at 32.50 is pretty likely. This is just to say that if you're still wondering what a defensive asset looks like, well, it looks like something that falls 2.5% when everything else falls 14 to 31%. Now, by the way, everything else I'm comparing it to is not something that I avoid. It's just why everything other than gold that I've mentioned so far is a trade to me. Silver, Bitcoin, the markets, even when I'm long on them, I see them as volatile. I see them as a trade. Now, one more fact here, since I just called gold a defensive asset, we need to point out that even with the market's historic recovery, gold is still outperforming the S&P 500 and the Dow for the year to date. Now, again, we're not here to tell lies. We're not here to act like gold is going to make us rich. But when your defensive play is outperforming your growth assets, I'd say it deserves some extra attention. So let's call it good there and hit the comments. Let us know if you bought the dips. I caught a few personally. Wish I would have caught some more. Probably a common case. Morgan Stanley, UBS, Deutsche Bank, they're all saying buy the dip in gold today. I don't know what they're seeing, but maybe the gold rally outperforming the market still seems like a dip. Who knows? I'm curious what you think, so let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.